Thanks everyone for coming. Tonight we'll talk about how to survive and thrive during a Calgary rental market downturn. So first, real estate market update. So before we talk about the rental market update, I think it's good to review where we're at currently with the resale market. So detached property and semi-detached, which is what I have here, we are currently in a balanced market overall throughout the city. There's obviously local pockets that may be a little bit different, but generally speaking, throughout the city, we're in a balanced market. As you see, the year-over-year prices have dropped a little bit. It's not a huge drop, right? Like semi-detached, we're talking about under 1% year-over-year, right? So it's mostly stable, but there's still a little bit of a drop. Most of that drop happened on the east side of the city. There's been a larger drop. The west side's been more resilient. Something to keep in mind. But 2.45 months of inventory, 2.73. These are a very much balanced market. We even see some very small part of the market that are still in the seller's market at this point. The story's a little different with townhouses and apartments. Those have seen fairly substantial price drop. And this is year over year. It's not like peak to current in terms of price drops. And when we see, like months of inventory, like apartments at 5.14, like that is a buyer's market. Like it has changed significantly. So townhouses are obviously not as bad, but apartments right now are definitely a lot slower. So that's kind of the point on the resale market. Now the rental market. So first chart I have here is from Yardi. Yardi is a property management software generally for larger operator, and I say that because the statistics have a bit of a bias for larger multifamily properties. So their year-over-year in-place rent growth, which is not growth right now, it's a drop, was just under -2%. Now it's not the headlines most of you have heard in the news, and the reason for it is most of these operators, I think, had not achieved peak rents yet. Right? When you have in-place tenants, you typically raise them slowly over time, or like raise their rent slowly over time, not necessarily the 30% we saw over a few year period, right? So if you have units that are still in the market today, even though the rents have dropped, you can still get a pretty good rent. So we saw smaller drops, but nonetheless, across the country, largest drop by far. And part of why is we also don't have rent control. So even though most landlords have raised rents slowly over time, it's still more than most markets that don't have rent control, right? If you're in like Montreal and you have rent control, you can only raise your rent so much every year, so those rents are still catching up. In the case of Montreal, the rents haven't dropped as much, but Toronto is an example where they have dropped. They're still catching up on the in-place rents because they have a cap on the rent increase. Now the lease-over-lease rent growth, so that's when there's a renewal that's happening, so a change of tenant. We've seen larger drop, although still not as bad for Calgary as I'll show later on the smaller units. And again, it's because some of those rents were not quite to market. But interestingly, is this chart is very different than this chart, right? And the main difference is rent control. Because when you have a brand new unit, now you're actually realizing the difference in the market rent. And we see that Toronto, Vancouver did drop more than Calgary for large apartment building, according to Yardi in Q1 2026. Next one's vacancy rate, which ties hand in hand with price drop, right? Generally, when vacancy rates go up, prices go down. And Calgary is definitely up there, at least in the multifamily space. I'll cover more about that later in the presentation too, because there's something else that this is telling us. Because multifamily operators have more of an incentive to try to keep higher rents, and they will sometimes take higher vacancy instead of dropping rents. So that's partly why we're so high on the vacancy rate, but it's not the only reason. So I'll circle back on that later. Next thing is rent growth. And I put this one because it shows it compared from 2020 in the Western markets, right? And one thing that's interesting in this is obviously Calgary went up more than everyone else, came down more than everyone else, right? So it kind of both goes hand in hand. But there's this little recovery here. It's very small, and it's not a big timestamp, right? But it's not something that any of these other Western market have. And we actually have a lot of other data that actually lines up with that small recovery in rent, so we'll cover that later. Just keep in mind that little notch there. And vacancy trend, well, it kind of goes back to the previous chart. It's high. It's higher than the other Western market. And we used to be lower than a lot of the markets, or at least on par, and now we're pretty high. So next one might be a little bit hard to read. It doesn't matter if you're able to read the actual number. The idea is that this is a chart. So it's provided by our friend Larry Lee at Canada ICI. He's been tracking rents every single day on rentfaster.ca for 2 years now at this point. Every morning he tracks it. And it's really good data because there's a lot of different property types, and it kind of gives an idea what's going on. So apartments, just down, right? Way down and down more. What's interesting on this, though, is there's some property types that have actually recovered a little bit, or have actually plateaued, right? And that kind of lines up, like main floor, definitely having that little bit of a uptick. And it lines up the previous chart I showed earlier. But what it also shows is that not all rent drop are equal, and not at all. It really depends on the property type you have. Like the apartment rent drop is significantly larger, for example, than the main floor, and basement suites have also a larger drop, right? So your own investor story with your own type of rental is not necessarily the same as someone else. And just because the supply is not being created equally either in these type of properties. Like we haven't added a whole lot of single family versus the multifamily or basement suites or those type of units. Another one that's interesting is the number of listings. So that's essentially inventory for the rental market. It's just one data point, rentfaster.ca. You can kind of ignore the darker graph. It's kind of confusing, but if you look just at the green one, which is the current one, the darker one's the previous year, you can see that we actually are starting to see a slight drop in total number of rental listings. And that's a good sign to see because we haven't seen that in a long time. This is a 3-year timeline. And it lines up again with that small uptick in prices. There's a lot of data points that confirm each other on this. Obviously, we haven't seen a huge amount of population increase, but we have still seen a little bit of population increase. So that line at the minimum should be flat or slightly trending up, right? So that's a good sign. That's on the aggregate of all property types. And then I broke it down in basement suites, main floor. Basement suites are pretty much flat, which actually surprised me. I expected it would still be trending up, but it's a sign that the market's starting to actually rent those out. They're not staying in the market vacant as much. So probably an adjustment in market rents too. But the main floor have dropped quite a bit. Like this is again, it doesn't look significant, but given the market cycle we're in, it's quite good to see actually. And then full houses, this one hasn't really changed because again, there's not been a lot of single family, like one unit, whole house rental added on the market a little bit, but it's not been the main driver of construction and new units on the markets. It's been pretty much like up and down for the last 3 years. Now a lot of change there. But apartment and condos we see like came up, and it's not really much of a drop. It's more of like the peak. It's pretty flat. And last year was really like the big increase, right? So they're the ones that are definitely very well supplied, is apartment condos and basement suites. So how to navigate this rental market, we just kind of covered. Well, first thing, protect cash flow, right? That's how you can survive. You never want to have to sell. You never want to sell when you have to sell. You want to sell when you want to sell or when the market is good to sell. So how many of you in the room have heard this, never drop the rent? Who agrees we should never drop the rent? Just curious. No one wants to chime in on this? Well, it kind of depends. So should you drop the rent? It depends. This is a very wide statement, never drop the rent. It doesn't apply to all situations. So if you own multifamily, especially if it's a larger multifamily, and that's defined 5+ unit, but especially if you're like 20, 30, 50, 100 units, you're building value is based on your net operating income, right? You're an NOI. So if you drop the rents, you're dropping your building value as well along with it, assuming the cap rate doesn't even change. And typically cap rate might even go up a little bit in those situations. And the 5x of annual rent drop, that's a 5x cap rate, which is kind of general average across the board. So if you're dropping rents $100, on a yearly basis, you're like $1,200. Well, 5x of that is your building value drop, right? It's significant. You're also creating a precedent. If you have 100 units and you're dropping rents that you're advertising, all your other tenants, especially if they're paying higher than those rents, now they want to get a rent drop. So it's kind of a cascading effect. So some operator will rather leave those units vacant at a higher rent, hope they'll rent a few, and then deal with some vacancy rather than have all the rest of the units drop in rent and affect their valuation, right? Especially if they believe it's a shorter term issue. If you have rent control, that's another thing too, right? Because when you drop the rent and you try to raise them back up, now you're fighting against rent control. But they still have to worry about higher vacancy, right? There's only so much that makes sense if you refuse to drop rent to take on as vacancy. So as more and more units come vacant or come due for renewal, it becomes more of a challenge, right? If you own single family or small multifamily, in the vast majority of cases, and especially for Alberta, it usually doesn't make sense to use that strategy. You're not creating your own comparables. You're not worrying about other tenants that are going to see your rent drop. A lot of times, if you have a larger portfolio, it's different buildings. The tenants don't even know other tenants exist within the same owner. So your vacancy typically will cost you significantly more than dropping to market and getting those units leased up. And in the case of Alberta, if you have a recovery after, you can raise the rents back up anyway because we're not bound by rent control. So I have a bit of a scenario here, right? And should you drop the rent, you could have a listing at $2,300 a month, sitting vacant for 45 days trying to rent it, and then you end up negotiating at $2,150. That's a lucky scenario where you're, still manage to rent it out in a reasonable amount of time. Scenario B, $2,150, you rent it in 5 days, which let's assume that the 5 day means you have no vacancy, like, you got notice from the tenant, let's say 3 weeks before, got it rented, they move in the day of. So then you get two scenarios, right? First one, 0 days vacant, because again, you lined up with a lease renewal. First one, you lost a whole month, let's assume that. Even though you got 150 less than scenario B, you're still making more on a 12-month lease, right? So obviously you have to do that equation for yourself. It will vary in the situation, but it's really important you do, because we talk to so many people that are like, well, I don't want to drop the rent, And then I've seen some people, Santhosh, I think they're like 7 or 8 months vacant. Yeah. You will never get that back, never. You need to adjust the market and get it rented, right? And those are people in the single family space, so they don't even have the argument of well, I don't want to drop my whole building. They're just taking on vacancy at this point, right? And that doesn't even account for the extra time, gas, for communicating with tenants, driving to showings, right? Maybe the one on market, you did 2 sets of showings and rented. Maybe the one where you tried to get the 2,300, you did 30 showings and spent all that time that you're never going to get back, right? And then Santhosh will talk about some ways, other ways you can use to protect your cash flow as well.
Yeah, so moving into this, so I'll start off with the first point of how you can protect your cash flow is appeal your property taxes. And this year, property taxes were quite all over the board. For the most part, everyone got pretty big increases. But you want to make sure that your assessment value is in line with comparable sales, right? So if you feel like yours is out of line, definitely come and talk to us. We'll be more than happy to provide you comparables, and then you can appeal your property taxes to get those in line, because a lower assessment value is going to equate to a lower property tax rate, so you can reduce your expenses that way. Next one would be review property insurance. So definitely insurance has been a big ticket item that's been kind of going up in cost over the last few years with all the hail damage that's been happening. Especially if you own a commercial, like a multifamily building, definitely shop around, because commercial insurance rates have gone up quite a bit more so than residential rates. Okay. The third point would be to carefully review your utilities, how much you're paying, especially if you own multifamily. You want to reduce expenses because your expenses are tied to your net operating income. So if you can reduce your expenses, then your building valuation is going to improve as well, right? So this could be simple stuff like upgrading, like if you have leaky toilets, make sure you're doing your quarterly or every 6-month inspections on all your units. Make sure tenants report any maintenance issue, right? And I've seen a case where thousands and thousands of dollars was lost because of leaky toilets, right? Especially in a multifamily building where the landlord's paying for water and it's a central system. Tenants never report that the toilet's running, and that's thousands of dollars of money down the drain, right? This also allows you to catch problems before they happen, okay? Another thing would be simple stuff would be weather stripping, right? So if you have like weather stripping that's kind of deteriorated, you want to look at things like that, okay? And the next point is to increase your effective rent, okay? And I'll cover a little bit more about what I mean by effective rent, but one of the things is you want to offload utilities to tenant. That's one way to increase your effective rent amount, right? So if you're currently paying utilities during your lease renewals, have that discussion to kind of offload the utilities, right? Even if that means you might have to reduce your rent amount a little, okay? Other ways you could improve on this is by renting out garages separately. So if you have a detached property with a garage in the back, it's a bit harder if you have a front garage, but if you have a detached garage in the back, that's often a popular way to gain some extra rental income. As you all know, we get hail here. So tenants with nice cars, contractors, people with a lot of stuff, they like renting garages, right? Especially if they already, even if they don't live on site. If they live in that neighborhood, like I have a tenant who's been renting a garage for 6 years, and all he does is park his utility trailer inside. So, and he's a contractor by trade, so he stores all his leftover tools and materials in there, right? That's consistent income, very low turnover. So that's one thing to consider. And yeah, storage space and parking, right? You could also offer free internet or Wi-Fi to your tenants as a way to retain them, right? So, and keep the rent the same. One thing to note, we put the asterisk there because if you do offer internet, that might come with an extra, you might have a little bit more work because every time your Wi-Fi doesn't work or your internet doesn't work, your tenants are going to call you, right? Hey, and then you're going to have to be the one calling TELUS or Shaw to kind of figure that out. So just something to consider. It is an option, okay? It might make more sense if you have a bigger building as well, so you can offer Wi-Fi for the whole like X number of units that you have, okay? Obviously, another way to improve cash flow would be to add a basement suite, right? Or you could also do a room rental along the same line, or furnished rentals, okay? So when it comes to retaining, like keeping tenants, ideally we want to retain them, right? We don't want to lose a good tenant that we already have, okay? And there's a few ways that we can go about trying to, as best as possible, keep the tenants that we already have, okay? Main things would be cleaning. So what you could do as a bonus, when you do a lease renewal, you could say, hey John Doe tenant, I'm going to throw in a free professional cleaning for you, during your renewal. How about that? And keep the rent the same, right? Or you could offer to do minor repairs or improvements to the property. I'll give you an example. A simple one you could do is, hey, you know what? You've been a great tenant. I'm going to throw in a smart thermostat for you. I'm going to take out the crappy thermostat that's on the wall. You have to manually press. You can now use a Wi-Fi thermostat, right? Small upgrades like that. It's gonna, you don't even need to buy a new smart thermostat. You could pick one off of Marketplace if you wanted to, right? So things like that are gonna make tenants feel like you appreciate them, right? And it's a small upgrade, and it also improves the property as well, okay? Another thing would be personal touch. Make sure you try to maintain a good relationship with your tenants, right? At the end of the day, they're our customer. They're the ones paying us. They're essentially growing our net worth, right? They're making us wealthy. So simple stuff like for holidays, give them a bottle of wine, whatever, gift cards. And remember, during tax time, you can just write that off, right? So, and then another thing is start communicating early when it comes to referrals, okay? So don't wait till the last 30 days and then be like, hey, are lease is coming up, do you want to renew? Especially in this market, start way ahead of time. So it could be about 90 days out. Start getting a feeler, right? So you want to see, hey, what's your plan? Are you still going to be working this job? If they're a student, are you still planning to stay here or move, right? Get a feeler. And ideally, then once you know their intentions, you can figure out your game plan, right? What you want to do, okay? So next up, just ways to re-rent faster. One of the ways you can do it is definitely reducing the rent. So I put rent not equals mortgage amount. And like what Anthony was saying, this is a common thing we see people being stuck on, especially newer landlords. So for example, if you have a townhouse and your condo fees and mortgage payments are, $2,300 a month, but the market rent for that townhouse is only $1,800. Like we've seen a lot of people just sitting at $2,300 a month on rent faster for months and months and months, just losing that money, right? So it's important to note that the market value and how much you pay in mortgage payments has nothing to do with the rental rate, right? So if you put 50% down, your mortgage payments are going to be, call it, $1,400. Doesn't mean that your rent also decreases, right? So it's the same train of thought. And get the property listed on Rent Faster even before it's vacant, okay? So in Alberta, we can do showings on a fixed term lease within the last 30 days, so make sure you take advantage of that. You don't have to list at the 30-day mark, list it before that, get some interest going, and then you could start your showings once you hit that 30-day period. Next one, very simple, just be responsive, right? So if you don't have time, make sure you have someone, maybe a family member, whoever can respond to emails, at least get some showings booked in. And you want to make your rental listings stand out. Everyone has crappy iPhone photos with like the lights on and it's blurry, right? And it's going to really make your listing stand out if you get professional photos and even a 3D tour done, right? It's going to cost money, but it's going to be worth it, especially because you can reuse the 3D tour, right? You can just keep that listing link and keep that going. And then when tenants do show up for showings, make sure your unit is clean and attractive, okay? Nobody wants to walk into a dusty unit that looks like the unit's been sitting for 6 months and they touch the countertop and it's covered in dust, right? Yeah, that's how you lose good tenants. And then you want to make sure you're listed on all available platforms, right? So in Calgary, the most popular one is Facebook Marketplace and Rent Faster. Rentals.ca is also another avenue. So Kijiji is another option, but it can be hit or miss for tenant profile. So yeah, ways to re-rent faster, again, offer targeted incentives, right? So you could do first month free. Anthony talked about it, how that math works out. And instead of marketing it as first month free, you want to put the free month at the back end of the lease, right? So you don't want the tenant taking that first month free and then leaving, right? So it's the 12th month is free, not exactly the first month, okay? Another option, you could include utilities, right? Obviously, depends on the scenario and what type of property you have, but that's another option, okay? To get showings booked, you want to make sure there's greater flexibility, right? Because obviously tenants are also working. One way that we found, and Anthony's been using it, I've been using it as well, is you can set up a calendar system. You can block off times where you're available. Like say you're only available Wednesdays from 5 to 7, and like Wednesday and Thursday, 5 to 7, right? Use a program like Calendly. There's many other programs out there, right? With like free, you don't have to pay for a subscription. That way you can just send the link to tenants, be like, hey, book in a time that works best for you. You just book, and once they book, you get a notification. You show up at the time, they show up. It also sends a confirmation. You could set it for a few hours before to make sure they're gonna still be showing up for the viewing, okay? Consider shorter or longer terms. So depending on when you're re-renting the property. For example, if you end up with a vacancy in mid-November, right? And you have to re-rent it. Ideally, you want to make sure the lease ends again in the spring, right? So either sign a shorter lease, or if it's a really solid tenant, then you could sign a longer lease that goes over goes through the next year into the following spring, okay? Frictionless application process, okay? Tenants have a lot of options to choose from. At the same time, you also want to do your due diligence, right? So you want to make sure you're getting the right person. So when you're starting, some ways that I've personally changed my process is during the hot market, I used to send them a checklist, right? So I'd say, hey, answer the following questions, and then I'd be like, if you're a good fit, we'll move ahead. But I found that it's not working because tenants have way more options. They will just move on to the next one. They can't even answer 5 or 6 questions. So what I do is I just go straight to a phone call, right? Hey, what's the best number to reach you at? And then I get them on the phone. And it's a lot easier to ask questions on the phone because they can't just hang up on you. Right? Even if they don't have an attention span, they're usually stuck on the phone with you for the few minutes, right? Next one is understanding your competition. So you want to see what other properties are around you, right? Obviously, there's going to be other rental listings around where you are, but what type of properties are they? For example, if you're renting a main floor unit, are you competing against like 100 apartment units in the newly built building next door? Or is it a glut of basement suites if you're in the suburbs? So you want to know what the price point is you're up against and who that tenant profile is, right? Okay. And then make sure you want to compare your effective rent. So if you're going to rent for $1,800, you're going to give a 3 months rent. What does that actually work out to per month, annualized? Okay. And then, you're also going to be competing a lot of times against new purpose-built rentals, right? For example, I can speak. I have properties in Bowness, right across 16th Ave by COP. There's easily probably almost 1,000 units right there of apartment buildings, okay, apartment units, and they're offering 3 months rent, free gym pass, blah blah blah. But here's the thing: it still doesn't affect my single family or small like fourplex portfolio because it's a different tenant profile, right? Someone who's going to live in a 1-bedroom apartment is not the same as someone who's going to live in a 3-bed or two-bed main floor or basement suite, okay? And given that the properties I hold are also older, they're in a different, they're generally bigger footprint, like larger square footage compared to some of these newer condo units that we're competing against, okay? Other competition that you can encounter is, short-term rentals that might be coming back on the long-term market. And then obviously you've got the downtown, like office to residential conversions, okay? And then when you're looking at Rent Faster, one thing that's important to note is what you see on Rent Faster is not what it actually rented for, right? It's the listed rent price, not the actual rented price. So yeah, this is the example of effective rent. So you want to compare the other vacant units. So assuming, we have two options here. Option one, $2,000 a month, and we're going to give first month's free, okay? First month's free on a 12-month lease, so it works out to $1,833, okay? So if you take $2,000 off. And option B is $1,850 with no incentives at all. So your effective rent works out to be higher, is $1,850 a month, okay? So that's what I was referring to by effective rent. So I've already kind of repeated this, but I wanted to put it back here again, but it's very important. Make sure your listing looks professional, right? A lot of tenants also don't want to deal with the amateur newbie landlord, so make sure they want to know that you're also a professional on the other end who knows what they're doing, right?
One thing to add to this is it's more common for apartments and condos. I find that professional photos, but like if you have a main floor basement suite, especially if it's an older one, it's a small minority that have nice photos. Like I would say 8 to 9 out of 10 photos on rentfaster.ca are garbage.
Yep.
So you'll definitely set yourself apart
because you have to
hire a professional.
Because you have to pay for photos, which most small landlords don't want to. But
like a little trick too, if you've done a renovation, definitely do it, and then you get to reuse these photos for the next 10 years.
Yeah, exactly.
So one-time fee.
Provided you don't change the flooring and paint. But yeah. And then I mentioned this earlier, clean unit definitely helps. And then pet-friendly policies, right? So if you're open to having pets, generally it's, we all know people with pets tend to stay longer because it's harder to find pet-friendly rentals, right? So if you allow dogs or cats in your property, that's definitely going to help. And then the quality of finishes matters even more, right? So now would be the time in this slower rental market, now would be the time to start your renovations. You don't need to be doing renos in a peak market because regardless of condition, you'll probably find someone to rent it. But now tenants are going to be picky, right? So if you've been wanting to do a renovation, now would be the time to start, okay? And then in-suite laundry. So in a hot market, tenants didn't really care if you had in-suite laundry or shared laundry, whether you had a dishwasher or no dishwasher. They didn't have the option to be picky. Obviously, the market's different now, right? So in-suite laundry will definitely help in this market, okay? Same with other stuff like dishwashers, right? So if your basement suite didn't have a dishwasher and it's easy enough to add one, definitely throw that in, okay? And laundry as well.
Like it used to be that tenant didn't really care if it was shared or not, but now
they're more picky about it for sure, yeah. Other things would be curb appeal, right? So if a tenant pulls up to the property and they see a dandelion field in front, it doesn't look great, and it's not a great first impression, right? So just keep the exterior tidy. You could throw in a few smart home features, right? Again, this could be an incentive for them to get in. You could do smart locks with keypads, smart thermostat, doorbell cams, things like that. And then obviously the rental units with a good layout, right? So especially if you're doing a new basement suite or you're purchasing a property, make sure it's got a open and a bright layout. You don't want it to feel like a dungeon the moment you walk in. There's like hallways and whatnot. And then make the move-in exceptional. First impressions matter, right? So make sure when they move in, they have a good impression and they have a good relationship with you from the get-go. Because how many of you have had a landlord who's not so great? Yeah. And did you end up staying? Did you feel like you wanted to renew the lease with them? Yeah. So exactly. So you want to be not that landlord, right? So you want to be a good landlord who would ideally be able to retain the tenant. Next one would be AC. And generally we would say for the majority of rental properties, you don't need AC. However, depending on the property type, right? So if you have a higher end property and it didn't have AC when you purchased it, it might make sense to add AC in. It's kind of a double win because it's like a bonus for the tenant, but also it's more suitable for that property and it'll help the resale when it's time to sell that property.
You do want to be careful if you have a main floor in the basement suite.
Yeah, ducting.
Definitely caution on air conditioning because you might have a lot of temperature issues in the basement. So there's a few workarounds around it, but you want to talk to a HVAC person. Like if you have a main floor plus a basement suite and you're putting in AC, you'll probably have a lot of temperature issues.
You might end up with a cold basement as well in the summer. So like an extra cold basement in the summer. So, and then the next one is a bit more of a niche thing, but you could add EV charging if it's really property necessitates that. So how does location affect rental vacancy? Again, the magical phrase location, location, location. So we want to buy near areas where the demand is a bit more consistent, right? So examples would be near the university, Mount Royal, State, Foothills, Children's Hospital. Generally a more affluent area of the city, and you get a big student population as well who's always wanting to rent in those areas. But a word of caution, even then you might not be immune to rental drops or vacancies because, for example, we've got University District now, and then if you guys have driven past the new cancer center by Foothills Hospital, they're doing that massive development right across, right? That's going to be a few thousand units in their high-rise buildings, right? So that's going to add a lot of supply. But again, who are you competing against and what's your property type, right? So is it a direct competition or is it kind of a macro competition, right? Something to consider. And not all neighborhoods have the same impact in a downturn, right? So depending on the proximity to employment centers and retail hubs, some neighborhoods will have bigger rent drops than others. A good example would be in Seton, okay? There's a lot of basement suites in Seton, okay? And pretty much every house was built with a basement suite and a side entrance, right? And the downside is now that the demand has kind of tapered off, the supply is just super high, right? So the vacancy for basement suites is through the roof. So at the peak of the market, we were seeing those one-bedroom basement suites renting for 17. I've even seen like 18, right? Just crazy to think about it. And Seton was, believe it or not, this was not our marketing phrase, but builders were saying it's a second downtown of Calgary. Okay, but now rents have dropped all the way to 1,100. Okay, that's a one-bedroom basement rent in Seton. So something to consider where you're buying. Okay. And then heavy secondary suite supply. So just what I was talking about, where you have a glut of basement suites that's going to affect your price. And then the new condo investor inventory. So units that convert between Airbnb and long-term. So a lot of buildings downtown, when they were built, they were actually marketed to be able to do short-term rental as well. And then won't mention which builder or builders, but after closing, the bylaws change, right? So they no longer allow short-term rentals. So then those units all end up flooding the long-term market. Okay. And then obviously you want to have a low rental turnover. You want to purchase in a place with low rental turnover, right? Good examples of areas where generally turnover is doesn't get affected that badly would be areas like Huntington and Beddington, okay? Because you don't have a ton of new builds to compete with those properties, and they're not downtown, they're not suburb either, they're kind of midtown, okay? And you get a lot of those people living there who are either generally blue collar workers or they're employed at the airport nearby, so it's a good spot to have low rental turnover there. Okay, and then I think I covered a little bit about this earlier, but you want to make sure you time your lease renewals correctly as well, okay? Rent prices in Calgary fluctuate and are pretty seasonal, okay? Because we don't have rent control, so it does fluctuate quite a bit. But generally, the best time to rent is between June to September. It's usually the warmer months. If you kind of miss that window, you'll realize that in Calgary, we can have as much as a 5% rent fluctuation from peak to off, right? Call it December to like April, you could see as much as a 5% swing in rents, okay? So like I was saying earlier, if you're gonna have to re-rent in winter, try to line up your end date in the spring or summer, okay? Okay, and then buying opportunities during a downturn, okay? So like Warren Buffett has said, be fearful when others are greedy and vice versa. Buy when others are scared of what's gonna happen, right? So generally, right now, it's starting to be a better time to buy into the market. You have a bit less competition. You can take your time to kind of review the numbers carefully, and you have a bit more negotiating power. We used to not even be able to put conditions in, right? A couple of years ago, everyone was writing unconditional offers and fighting like you threw food in a koi pond, right? But it's a bit better now. Improve existing properties. So like I was saying earlier, now would be the time to start doing renovations if you're having trouble renting. Trades are also a bit less busy because also there's changes coming up with the blanket rezoning and all that, okay? Build better systems. I won't go into detail, okay? Can be less risky as well to buy in a downturn, because if a property cash flows today at current rents, you're fine, because rents are good. Even if rents drop, make sure you stress test your portfolio, but rents, if they go up, you're going to be definitely fine with cash flow, right? And finally, Layne, hand it over. Let's try.
So yeah, what are the things that I know both these guys touched on, but that is really important, and this will be my third downturn in Calgary now. And one of the things that I did really notice, that when rents go down, the property condition matters more than anything. So a lot of people are like, oh, rents are going to go down. I want to kind of cheap out. I don't want to spend on that stuff. It's the exact opposite way of what you should be doing. So when a tenant, when you look at the what's in the mind of a tenant, as they're renting a basement suite for $1,600, in Seton, then they're already going to be going down to $1,300 or $1,200. Or whatever it is, they're already going down, so they can already afford rent. So now it's a matter of, well, another $50 isn't the same incentive to just try and solve your, I can't rent this by dropping the price. If the market is busy and the market is increasing in terms of rents, if you can't get a rent, you drop it $50, people are desperate for that little bit cheaper, so it's okay. But they've already acclimatized, so to speak, to the rent for a few years, and now rents are going down. It doesn't matter to them whether it goes down $250 or $300. So you can't just drop the rent and expect it to have the same impact. They're already used to it. They're already getting cheaper rent. So now they're comparing a good property with a bad property. So you really need to be in the better half of properties out there. So spend that time, put in the new countertop, put in the new cabinets. It's actually worth it now. This is the time when you should be doing renos. Don't wait for the boom. Even if that's when you might have the excess money, it makes more sense, or it feels better to do it at that point. But it's more important to do it now, because you won't go that extra month vacant. You won't end up dropping the rents anyways to the same amount, or you might drop it anyways, but at the same time, you're just going to be better off long term with that. So just keep that in mind. I know it tends to be counterintuitive that rents are going down. So why would I spend more money? I want to try and save as much as I can, but it is the wrong approach in this type of market. So for those of you who have, heard me, have been here before, you've heard me talk, and I've been negative about rents since 2022. Not necessarily that rents went down in 2022, but once we saw the MLI Select product come out, I immediately, we were in the middle of a deal. We spent $120,000 on getting that rezoned, which we still have, so it's good. But six units in Highland Park to renovate and do 64 units. And once I got the feel for that full MLI Select product, 95% financing, 50 or 55 year amortization, 95% financing, where you could actually see that a builder could pocket money at the end of their transaction. You could buy a commercial property, pocket a whole bunch of money, still own the property, and just finance it all. So then you have more money to do 1, 2 more. So builders were making more money than they've ever made before by building for themselves and then just financing it. They weren't selling, they weren't getting rents yet, but they were already making a lot of money. So I just saw this as like, this is going to end poorly. And so over the last few years, we've seen that play out, and we have seen rents and too much inventory hit the market. And then we have, the other problem of, we had from a mass amount of immigration. Like, we tripled immigration for a few years and then cut it to zero. Like, it just doesn't make any sense why a government would do that, but the same government did both of those things. But it clearly caused a problem of overbuild in a place that it's really easy to build. It's just Calgary's regulatory environment makes it easy to build, along with the extra financing, which was over generous and not needed in Calgary, but it was really designed for Ontario and to some degree BC. So the product was, you've probably heard me say this before too, the product was so good that it's bad. It was too generous, too good. And in Calgary, it just made it really easy for people to make money, even if now they're holding on to sometimes, in some cases, negative cash flowing properties with negative equity and no principal pay down every month as well. So I've been concerned about that for years, and we had seen rents drop. And I talked about, my estimation was we were 30% from peak to trough, 30% rent drop. The peak only lasted a year, and we dropped 15%. So if you rented something for 2 years, and if you rent something at the end of, in 2022 in January, and it's come up for release now, you're still going up in rent. But if you rented at that peak and you're now re-renting, you might see a 15% drop. So I feel like we very quickly dropped off the peak 15%. The pressure got pushed off. The competing bids for rentals kind of stopped. But I still feel like there's another 15, and I was thinking even 20% to go. And I'm an aggressive investor, but I'm also paranoid. I want to make sure my downside is covered. So as I see all this record-setting inventory still under construction, and the lag time from the reality of, oh no, these aren't making money anymore, to when somebody is mid-build, they can't stop now. CMHC put the rule in that you have to tear down your house before you can even apply for MLI Select. So people would tear down the house, then apply. Now they kind of have to see it through, because what else are they going to do with a $900,000 lot? They got to put a $2 million project on there, try and sell it, break even, or even lose some money, but it's better than losing the 900, having 900 tied up. So we end up with in this kind of dynamic where the fundamentals don't necessarily all balance out, and we have too much inventory, and we still have more kind of hitting the market. So it was scaring me quite a bit. I was like, okay, maybe 15% to go is still even generous. Maybe it's going to be worse than that. And instead of it being 2 or 3 years, it might be another 3 or 4 years. So in making investment decisions now, I'm still buying, I wanted to kind of look to see how much cushion that I had. So I started looking into more details of something I've always kind of paid attention to, but I left it in the back of my head after I looked 10 years ago at some of these stats. But I started looking up some things again. And this is, over immigration, record-setting inventory under construction. Sounds like bad news, and it is. But this is where the details matter. And this is what I just looked into it again as a precaution for myself. And so this is where the details matter. So does an intercity 8-plex house 8 more families? I'll say the answer. The answer is no. So does anybody have a guess as to why? actually smaller homes, so it's not as conducive for families. Right. So that's one. In a household unit family, that could be one person or it could be five or whatever it is. So that is one of the correct answers. Anybody have a guess to the other one? To build an eightplex, does it house 8 more sets of tenants?
I can't guess because I know the answer.
Yeah, yeah. And the answer is no, because what has changed is this densification that has been pushed on us, including zoning changes, including the MLI Select design, everything about this. We are doing a far more multifamily, but we're not building single family homes on the edge of the city anymore. We're building multifamily, and we're doing it inner city. Well, what's the difference between greenfield development and inner city development? Any guesses? Grass, yeah, that's one of them. Any others? So what was on the lot that you built the eightplex on? Right, and it probably had a basement suite in it if it's in Highland Park or if it's in Bowness. So the lot wasn't vacant. If you're building a fourplex, but you're tearing down a bungalow with a basement suite in it, you're adding 4 new units. Well, actually, you're only adding 2 new units. And that's the difference between what we've seen over the last 10 years of mainly peripheral city building, single family homes or townhouses on the edge of the city where it was a farmer's field they were taking over. They weren't taking anything off the market. So in that case, if someone's building infills, they took down, one house, maybe even, 2 units to build 2 infills. Well, they haven't added any new actual housing stock, except for the bedroom comment, which works in reverse as well. So the lot wasn't vacant. The house fits more appeal to the condo. So this one does make a lot more sense. So, if it's half of these units, especially these townhouse ones, we've seen them all over Bowness, Highland Park, everywhere you see the corner lots started, and then it started everywhere, the courtyard townhouses, which is what our development was incidentally as well. So not only of an eightplex is only adding 6 units, or a fourplex is only adding 2 units, if you're tearing down a house with a basement suite, you're adding less bedrooms, because a 1-bedroom basement suite is tiny. It's 4 units, but half of those properties are half of the units are 1-bedroom basement suites, 480 square feet. In fact, they restricted it to be under 500 square feet for a very long time. So they did away with that at some point, but you could not go over 500 square feet. So it's purposely small. You can't have a couple of roommates rent that. It's even hard for a couple to rent. There's just not enough space. So this is our development. So our development has more density. So we're just in a location that was good. We were in what eventually turned into HGO, but we were able to get more density than the typical HGO. So you've got your 8-plex on a corner. That's kind of standard. Everyone knows that. The HGO zoning would allow about 10 units per 6,000 square foot traditional lot in those neighborhoods. And in our case, we're able to get just about 11. So we were able to get more density than the typical development. But here's how our numbers break out. So 64 units, courtyard townhouse style. So we had 6 bungalows. Every single one of those bungalows was 3-bedroom main floor and 2 bedrooms in the basement. So we actually had to take 12 units, but every one of them had a basement suite. So it's actually only 52 net units. So 64 units, but it's only 52 net units. So 81% of the actual new construction units, which we would read in the paper, go, oh, that's how many units are going to hit the market. Well, once we build, we've got to get rid of 12 units to add that. And we're going to end up with only 81% of the advertised kind of construction statistics. They don't minus off what you've torn down in the numbers. They just give you the amount of new builds. Then if you look at it from a bedroom perspective, to Richard's point, the 32 units, so we have 3 bedrooms and then the 1 bedroom tiny in the basement. From a bedroom standpoint, it's even worse. We had 5-bedroom houses. We had to take down, basically 30 bedrooms to build 128, which is still a lot of new bedrooms, but it's still less. It's, 76.5 the amount. So, You could somewhere in between for at least the inner city properties, you could take those same stats. That 20,000 might convert into 15,000, maybe 14,000. Maybe it's 16, but it's not quite as much. And it did change the dynamics of what I was looking at as because I compare population growth. So we have significant population growth coming in still, not as much as before because of the international migration.
To this point, some of these are not even larger multifamily, right? Because sometimes you tear down a single-family house with a basement suite and you build an infill, side-by-side infill. You go from 2-unit to 2-unit, but it still counts as a new construction.
Yeah, it still counts. It is zero. It's actually zero. And then there are a lot of 4-plexes and then 8-plexes. I'm giving an example of one of the more dense versions. So this is on kind of the higher side. Now, of course, there are versions where somebody will build an actual apartment building or a 5-story building as well. I think this is a pretty good example of be conservatively on the high side of how many more units we're going to get. So when you compare it to population, I was thinking, we're gonna add another. We're already in a soft market. We're going to add another, 25,000 units compared to what we actually need for our population growth. And now I'm thinking it's anywhere from 0 to 5. Like we're in a soft market, so I don't think we're not gonna boom it. Like there's not gonna be a constraint anytime soon, but I don't think it's near as bad as I was thinking. I think, and it's reflected. It's funny because the day I got paranoid about this, about the time Anthony sent us another property to buy. So because we do keep buying, I started like really getting paranoid. I was like, okay, I'm starting to use up a lot of my liquidity. So I looked into this and I immediately went into like a 5-hour, like looking at all these numbers again. And I'd done that once before 10 years ago, but the dynamics had definitely changed with the type of property that was being built. And we're going to get into more details. I'm going to go into more depth on this in August. But it has changed, that it's not near as bad as I thought it was. But let's just see where we're at here. Yeah, this is also the average here. So this is the apartment purpose-built rental. This is. I just did this on ChatGPT. So Sorrel, what's your source? That's okay. That's why you're laughing. Yeah, but what's the source? ChatGPT. I'll tell you. So it's really this isn't like any kind of scientific data or anything, but it's probably relatively accurate and it makes common sense too. It's what we've been talking about, an apartment or condo, very little units. So this is what kind of made me feel a little bit better. I was like, we're actually building way more apartment condos and or these townhouse style units, which at least 50% of them are 1-bedroom, tiny little units. So not near as much as the typical, when I compared it 10 years ago, single family house with 5 bedrooms. Or 3 up plus a basement. So the dynamics change quite dramatically in this, and it makes me less fearful of how bad it's going to be. I don't think rents are going up anytime soon, but I don't think we're due for a 15 or 20% drop, and it was a bit of a concern of mine. And incidentally, within 2 or 3 days of that is when Larry sent us those stats that Anthony was talking about, where the rents kind of stopped going down. And then in some cases, depending on property type, started actually going back up. And that's anecdotally true for us too. I've had a few rental renewals that have come up. They've renewed at rent price. Last year, everyone wanted to drop. Not so this year. And the two tenants so far this year that moved out early because they bought a house, I've re-rented in actually 3. So I've had 3 re-rentals. And in 2 of the cases, I was able to increase rent about 5%. So I think anecdotally, this lines up with not being as bad as I was once fearing of, a reasonable possibility that rents would be even lower and then even last a little bit longer. So I think this is going to be a little bit shorter. Again, don't count on rent increases. Make sure you have a buffer. Do everything we're talking about in terms of we are still in a soft market, but this is, this might be the first time. And not that this is good news, but it's less bad as you might have heard me talk about before in terms of short-term rents, which I don't think you make investment decisions based on, but it's just important to understand that because we're all trying to be good investors for future value, but we got to have cash flow in the meantime. This is just a teaser for August. Alberta is just crushing everything. We were partially because we were suppressed for so long. We have just a lot of runway. Our prices could go up and we're still affordable. It's a really good place to do business, no matter what kind of business that you are. We have a really good tax regime, really good regulatory framework for almost everything. Businesses are moving here from across the country and across the world. If they want to do business in Canada, it just seems to be a good pick. We had massive job growth last year, by far the biggest in the country, while we lost 10,000 oil and gas jobs, which is also an important indicator. We're not as subject to oil and gas. It used to just be, we'd only get jobs if oil was booming. Oil wasn't booming last year. That's been a this year phenomenon. And yet, so we lost 10,000 jobs last year, but we still gained the most amount of jobs of anywhere in the country. And our jobs aren't government jobs. Our jobs are actually private sector jobs, which is a big deal. This doesn't even remotely show this 3 point. It kind of looks, okay, we're just at the top of the top of this. But I mean, this is Prince Edward Island. So they had 12 new people get jobs last year. That's a 2.9% increase in their employment. So, and not to slag on any of these provinces, but they are smaller. If you look at the big four, which is Ontario, Quebec, BC, and Alberta, we're the smallest of those. And all of the other provinces combined, we're still bigger than. So we still have higher population. So this next slide is a little more appropriate. This is the first 5 months of this year, including last month, where the good job numbers came out. But the good job numbers still, the two biggest, or the two provinces, with the highest prices and the biggest issues, they're losing jobs. Ontario is, where's Ontario here? So they had some job growth, partially for last month, but the rest of the country combined hasn't met even close to what we've done, just in Alberta. It's really hard to emphasize all of the good things about this. It's not oil and gas stuff. It's diversification. It's not public sector jobs where you're just borrowing money, which is where any of these Ontario jobs are coming from, and Quebec and BC. So we're really the income generator for the country right now. Every data that you see that our country is doing, not as bad as we think, or there's been a net positive job growth. If you take Alberta out of that, everything's negative. So it's only in Alberta that's doing good, which gives us a lot of tax revenue, which gives us a lot of growth, which means people are going to continue to move here. The more tax revenue we have, also from the oil and gas tax revenue boost, we've basically wiped out our deficit. In the beginning of March, we had almost a $10 billion deficit projected. It's now gone. So even if oil prices went back to what they were, we've almost wiped that out, and they're not likely to go back. Plus, there's going to be now a premium on our oil and gas. It is really hard to get projects developed in Canada, but once they're developed, they're secure. That's no longer the case in the Middle East. So there's going to be a premium associated with getting something done in Alberta, where the energy source, once it's a struggle to get it done, but then you can count on it. So we're going to start getting a lot more investment back for oil and gas. So we were losing oil and gas jobs. I think that's going to be coming back, but it also allows revenue, so we don't have to increase business taxes, so we can generate other different types of business. So everything I see is just good. And again, we'll talk more about this in August. We'll have some more updated stats as well. But this is the stuff I've been bullish on for a few years. The Alberta economy in general, so long-term, 5-10 years, everything in Alberta is doing well. Short-term rents, I was a little more negative on, a little less negative on now. Employment growth, kind of just more of the same. Alberta's just doing all of the job growth. From the line is zero, if you can't see that, and then basically everywhere. Ontario did have a little bump here. That was just the stats that were reported last month. But we've been consistently, and this is even, but it's a 3% growth rate. That's what it's even with. So this is, they're actually losing jobs for the most part here. And this was just kind of a fun one that I almost don't understand. Top 25 growing millionaire hubs in the world. And this one wouldn't surprise me so much, but it's actually from 2014 to 2024. So the last 10 years, or not even the last 10 years, 2 years ago, the last 10 years. this one surprises me that we're the only Canadian city on this, because we didn't have the tripling of our real estate prices. I don't know if they maybe pull real estate out of this stat. I got to look more into this because this one is interesting to me, but it is a like I'd like to see what that is over the last 5 years, because now we've had not negative growth in real estate, we've actually had positive growth in real estate. What's that? Oh, that's, yeah, fair enough. They're getting too taxed everywhere else, so they're moving to that also could be it. So yeah, I think that's pretty much it. Obviously, actually, does anyone have any questions for Anthony, Santhosh, or any of this stuff? Anybody have any good examples of what you're doing to keep good tenants right now?
Anything creative? Anything we haven't heard? No?
All right, I think we'll wrap it up. Yeah.
All good. Well, thanks everyone for coming.